The idea that I'm going to lay out here for you is a concept to possibly help the mortgage situation that we're involved in right now. Now, basically, the example I want to use here right now is one in which we have a homeowner, and they have a $100,000 loan with a bank right now on a piece of property. Now, this homeowner right now, we're going to keep this loan something that's possibly a variable rate loan, 5 years, with a low interest rate on it, possibly 5% to a bank. So right now, this is a variable rate loan. The loan is coming up due to have to be refinanced. The homeowner is looking in possibly going into a default situation, and the home is close to going into foreclosure. Now, the reason is the homeowner can no longer make the payment when he refinances. The homeowner can no longer wants to make the payment because the value of the house has dropped so much that to come up with more additional money to buy into the home, they aren't incentivized, so they're wanting to walk away. The goal is here is to find a solution that actually does not use as much government money or very little government money that's being proposed right now. The idea is to actually form a fund called the Private Mortgage Fund. And this is something that's funded outside of government with institutional investing, private investors, what have you. The concept is that the private mortgage fund would actually come in and buy this mortgage from the bank. Okay? So the private mortgage fund comes in and buys the mortgage from the bank at a discounted rate. Now, the concept here is that everyone's going to have to compromise a little bit of this. The goal is to reduce, to actually minimize the compromises and to spread the compromises out over multiple bodies instead of all at one. This will help spread the impact on the economy. So for the sake of this discussion, let's say that the bank actually has a $50,000 value of after foreclosure, after possibly how long they have to carry the home for going into next year, that truly is what maybe the home is going to be worth in a foreclosure situation. That number could be different. So please don't take these numbers as exact. This is just to actually outline a possible solution with a formula here. The numbers can change and I'm free to open for any suggestions to have those numbers change that you might add to this. But for the sake of discussion, let's say that the bank actually is looking at a $50,000 value on that $100,000 loan in the event that they had to go through the whole foreclosure process. The private mortgage fund agrees to buy this loan for $65,000. Okay? Now, this amount that they buy it for can vary. It's going to be commodity driven based on the quality of the actual mortgage, the marketplace at the exact time. As the economy starts to go up, this number could go up. As it goes down, it could go down. The point is, this is an actual market-driven price that they buy it from the bank. The key is that the bank is actually going to receive more money for the mortgage than they would if they were to go into a foreclosure mode. So the goal here would be is to get this number higher to the 100 for the bank, and for the private mortgage fund, it would be to get it lower so they have a higher, better, purchasing something at a better discount. But again, this can all be market-driven, and not which actually would allow it to adjust for the times. Now, in this situation here, the homeowner would no longer have a mortgage with the bank. What would happen is that the homeowner would have an agreement with the private mortgage fund to actually continue paying the exact amount that they were paying before. So let's just say, for example, it was a 5% loan. Let's say they were paying approximately $450 a month, or 5% on this, in the variable interest rate mortgage or loan that they had with the bank. They're going to continue to pay that to the private mortgage fund. Now, in this scenario, what's the reason why they would do that? Well, part of the reason why the homeowner was having trouble with the bank is they actually had to go into a refinance situation, requiring a higher mortgage rate and additional deposit money to qualify for it. So in this situation, they're motivated because they get a stay in their home and they're able to make the original payment that they had going on. But I want to stick with the private mortgage fund, the benefits here, and then I'll come to the homeowner in just a second. What happens here is the private mortgage fund has bought a $100,000 loan for $65,000. In essence, their net gain is they'll actually receive approximately 7.5% interest on this, on their money off of their $65,000 investment. Now, what they also get is they've got a situation which we're going to formulate as an incentive plan to keep the homeowner into the home, so they actually aren't just buying a home at a liquidated value, they're buying it with a tenant that hopefully will continue, or a homeowner that will continue to make payments to the private mortgage fund long enough for the private mortgage fund to be able to sell the home. Now, here's where the final part comes in. Private mortgage fund turns around and offers to sell the home in 2 years. Now, the years or the rates that we're going to do on here can vary. Please, I'm open to your suggestion. It's just an idea. In 2 years, the homeowner is given 5% of the net proceeds if they stay in the home for 2 years. If the homeowner stays in for 5 years, then they get 10%. If they stay in for 10 years, they get 15%. And if they stay in for 15 years, which would be the goal, then they possibly get 50%. Okay? Now, the percentages in the years can vary. This is just a layout as a concept right here. So the private mortgage fund is going to benefit because they're going to get 7.5% of the money because they bought the mortgage at a discounted rate, and they're going to benefit because they're going to receive the profits from the home when it's sold after a period of time when the market starts to stabilize. Now, that's the benefit for the private mortgage fund. We've looked at the bank. The bank's able to get liquidity back into the bank at a higher rate than what they would get if they went into foreclosure with all the loans. Let's look at the incentive for the homeowner. First off, homeowner stays in their home. A big plus, okay? So we keep the homeowner in their home. Second of all, the homeowner is able to possibly get a credit incentive to stay in. Now, a credit incentive is something in which does not exist right now that I'm aware of, but is something in which if the industry got behind this, and the government did as well, whereby if a homeowner agrees to turn around and go into a private mortgage fund agreement prior to going into foreclosure, then on their credit report there's an adjustment made to offset the fact that they were maybe late payments to the bank, or that the foreclosure actually took place, or that the mortgage disappeared. You have to give the homeowner a reason to stay in the home, and one of the biggest reasons to keep people from going into foreclosure is to help them with their credit. Third reason is they get a profit. Okay, so they're going to benefit by profiting by staying in the home. Now, what we're going to look at is to how to possibly increase that profit and make it so it's actually a big gain. The goal is you got to motivate that homeowner to stay in. Okay, so a fourth reason, give them a tax incentive. Now, this could be something where the government agrees that if they stay in for the whole 15 years, the key is they got to stay in for 15 years, then they don't have to pay taxes on their gain. Now, yes, the government is actually going to be losing out on that in the 15-year time period, but what we're doing right here is the government's going to have to compromise because we're going to need some government incentive, but maybe not all $700 billion goes straight to the bank. We leverage it, so the $700 billion might have a much higher value to a much greater number by not dumping it all at once, by leveraging it out with the homeowner in a private mortgage fund. So the tax incentive is that if they stay in for 15 years, they get a tax incentive, okay, so that they don't actually have to pay taxes on it at that time period. Now, in the end, what happens is the risk goes down, okay? Why? Because they don't have to turn around and make a deposit on the home to refinance the home, so they don't have to put more cash out. They actually now are in a situation where they have an agreement with the private mortgage fund. They've fixed their credit situation right here. And in the end, what I'd like to see is maybe someone could actually comment on this and see, because I haven't done the math on this, I just know that the concept works, that if you give them a tax incentive here, plus with their reduction in risk, with 50% net gain after 15 years, would they come out higher or close to what they would have done had they stayed in the home on a regular 30-year mortgage? So the concept here is to turn around and see, can we incentivize the homeowner to stay in? Are these enough incentives? If there's more ideas as incentives, I would be open for your suggestions. But the homeowner is now incentivized to stay in. That helps the private mortgage fund because then they keep someone paying on that mortgage until the economy stabilizes, allowing the home to be sold at a gain. Now, the private mortgage fund might need a boost. This will be the last point I'll make here. The government, to get this started, may need to turn around and offer a guarantee to the private mortgage fund in the event when they buy bulk amounts of these mortgages, that even in this agreement that the homeowner is going to make with the private mortgage fund, that they might still go into default. The person could actually completely lose all their income whatsoever, and they have no ability to make even this low payment to the private mortgage fund. Therefore, there's a default situation. The government, there can be a level of guarantee in which the government agrees to actually make that payment until at such time someone can come in and replace that payment. Now again, the government's not stepping in and putting in the whole $100,000. The government's just stepping in to make that payment until this can be rectified. Now, it's a level of government insurance on this to help the private mortgage fund attract dollars into it. Now, one last thing that's kind of interesting about this, if this was to go into default, private mortgage fund agreement on a home, what an interesting way for this home to go up for sale in which someone could actually come in and replace the position of that homeowner in the private mortgage fund. In other words, there could be a whole secondary market right here in the event that these are sold on the open market. It could be a great way for a new homeowner to actually come into a home because they're able to walk right into a home, possibly, depending on how this works, with no down payment, picking up the private mortgage fund agreement, and actually continuing this plan right here. It could actually offer a whole new infusion of customers into the marketplace by buying a home under a private mortgage fund agreement.